This is Nightly Business Report with Bill Griffith and Sue Herrera.
Apple makes history. Today, it became the first publicly traded American company to be valued at $1 trillion.
Place your bets. Vegas bookings are down at some hotels, but is this just a blip on Sin City's radar?
Lemon squeeze. Record-breaking temperatures are pushing prices higher, leaving customers with a sour taste. Those stories and more tonight on Nightly Business Report for Thursday, August 2nd.
And we bid you good evening, everybody, and welcome. So the race to $1 trillion finally has a winner. Apple today became the first publicly listed U.S. company to achieve a total market value of $1 trillion. That number, by the way, is the result of multiplying a stock's price by its number of shares outstanding. Now, the milestone underscores the device maker's longtime growth and highlights its role not just in the technology industry, but also in our everyday lives. Apple stock today was up about 3% to close at $207.39. The company's shares have risen more than 20% this year, getting an extra boost on Tuesday after reporting better than expected earnings and revenue. But you know, Apple is not the first Dow component to make valuation history, and it won't be the last. But Bob Pisani takes a look now at the companies that came before it.
Apple's march to $1 trillion today marks the latest milestone in the corporate race to sky-high valuations. You know, the runner-up, of course, is a company that has its hands in virtually every industry, and I'm talking about Amazon. The very first company, though, to hit the $1 billion mark, you're never going to guess. It was U.S. Steel. It was all the way back in 1901. Right at the start of the 20th century, when the demand for raw materials paved the way for that company's success. The race to the first $10 billion company, though, was a really tight one. General Motors became the first to cross $10 billion in 1955. DuPont, AT&T, and Standard Oil were not far behind. After that, the first company to hit $100 billion was hardware giant IBM. That was in 1987. The first to hit $500 billion, software giant Microsoft. That was 1999, right on the brink of the dot-com bust. Both IBM and Microsoft were well ahead of the next three largest contenders. Now, Apple was actually the sixth firm to hit the $500 billion mark. That was in 2012, after the likes of ExxonMobil, Microsoft, and Intel, all of which had fallen well below that mark by the time Apple got there. By the way, it's worth noting that Facebook and Amazon only hit $500 billion last year, along with Chinese communications giant Tencent. That's the first Asian tech firm to reach that valuation. Keeping track of all those numbers? For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Yes, Apple was not the first company to ever hit $1 trillion in Asia. PetroChina briefly passed that level back in 2007, but in the subsequent year, it was worth less than $260 billion.
On Wall Street, Apple's climb was not enough to give the market overall a big lift. Investors remain concerned about trade, especially with China, and that kept a lid on the gains. The Dow Jones Industrial Average fell 7 points to 25,326. The Nasdaq added 95. The S&P 500 was up 13.
It is still unclear where trade relations with China are headed, but there appears to be some movement on trade with Mexico. A delegation from that country arrived in Washington today to discuss changes to NAFTA, where the focus has been on sticking points like autos and possible wage hikes. But there clearly is no deal yet. Mexico's economy minister was quoted as saying, everything will fall into place or nothing will fall into place.
Well, now that summer is about halfway over, we thought it would be a good time for our viewers to take a closer look at their portfolio and make sure it's well positioned for the fall. Joining us to offer his insights is Mark Lucchini. He's the Chief Investment Strategist at Janney Montgomery Scott. Good to see you. Welcome back.
Thank you, Sue.
So I can't believe how fast summer is going. So as we approach the fall, what are the key issues that you're looking at and that our viewers should pay attention to if they do need to reposition that portfolio?
Well, Sue, for us, of course, is are we going to continue to see the same strength in the U.S. economy as we've seen over the first half of the year? And I think that's an unambiguous yes, in our view, that we're seeing this inertia carry through the remainder of this year and well into 2019. So that's supportive of corporate assets overall. Secondly, of course, as we're moving past earnings season, we have this void of new information. Next Fed meetings in September, they're likely to hike rates. In addition to that, we're coming closer to the midterm elections. and of course the Iranian sanctions being reimposed. And so there are still some geopolitical and outright political, domestic related political issues lurking out there that I think are going to be potential landmines for investors that they have to watch for how things evolve. But between now and then, I think the environment for stocks by way of the prospects for corporate earnings remains very good.
Okay, let's unpack some of that. The Iranian sanctions, the possibility that theoretically would push energy prices higher. You like energy stocks then, right?
We do, Bill, and not just because of that. In fact, I think it's an asymmetrical outcome that we project that the risk is for oil prices to go much higher as a consequence of Iranian retaliatory actions or perhaps the collapse of oil production in Venezuela. We think oil prices remain elevated just because the oil supply-demand imbalance tilting toward greater demand than supply is likely to keep prices elevated, which should be profitable, and therefore for particularly exploration and production companies who are seeing from the major integrateds budgets expand, and they should stand to benefit from the spend.
So let's take a look at your top picks, and one of them is in that area, Pioneer Natural Resources. And you've just mentioned the reasons why you like that, but also you like PNC Bank and Microsoft. Why?
Absolutely, Sue. Domestic economic conditions, of course, supportive for general business activity, particularly lending in the commercial and industrial space. PNC is kind of an upper tier super regional bank that benefits from some capital market activity, but more principally commercial general banking activity, which the raise in interest rates or rising interest rates on the short end continue to provide a nice cushion to their net interest margins. And as for Microsoft, of course, the company's done very well, being picked up along with the rally in technology stocks, given back a little bit here of recent, but nonetheless, as businesses continue to spend, and we saw great numbers coming out of the second quarter GDP report that showed business investment up over 7% on an annualized basis, software technology tends to be the disproportionate beneficiary of business spending on productivity, and so we think that's a winner.
Excellent. We'll leave it there, Mark. Thank you so much. Mark Lucchini with Janney Montgomery Scott. Bill?
You're welcome.
Well, ahead of tomorrow's monthly employment report, another report out this morning showed so-called jobless claims inching higher, but still clinging to a 45-year low. The number of workers filing for new applications for unemployment benefits rose by 1,000 last week, a small increase. Economists still say this is the strongest labor market the U.S. has seen in decades. Tomorrow's monthly jobs report is expected to show a rise of 190,000 non-farm payrolls, and for the unemployment rate to come in at 3.9%.
The gaming business in Las Vegas remains in focus. Yesterday, it was because of what Caesars Entertainment said about its outlook for the Strip. Today, it was MGM's turn. The company warned of waning demand at the Las Vegas casinos, tighter margins, and it missed both earnings and revenue estimates for the current quarter. The stock traded lower most of the day. It rose a bit going into the closing bell.
So is Las Vegas experiencing a bump in the road, or is there something else going on? Joining us tonight, Dan Peltier is a reporter for the travel website Skift. Dan, thanks for joining us tonight.
Thanks for having me, Bill.
Vegas has changed its spots so many times over the decades. A gaming mecca, a family destination for conventioneers, for just outright tourists. What's moving the needle for Vegas right now, and how healthy are things?
What I've noticed in recent months is that convention business is really doing astronomically well year to date. Even later last year, it's growing double digits, and that's really what's key for Las Vegas right now. Leisure travel in general is down about 1% in recent months, as well as last year, but convention business is soaring, and that's really what's most important. Convention, goers and business travelers spend more, right. They're more valuable. So that's a great sign for Vegas and what's driving them right now.
So we've seen the stocks of MGM and Caesars fall in the last couple of days, a lot of volatility. Are the issues that they're talking about then, in your opinion, specific to those companies, and the rest of the Strip and the rest of the city is pretty healthy?
That's right. I think it's very specific to Caesars and MGM. I mean, with Caesars, they're coming off of bankruptcy, escaping that, and MGM unfortunately had that horrific shooting latter last year. So I really think those two are anomalies. Other hotels, resorts, casinos have strong earnings for this quarter. And I think we're going to see a rebound as the year continues, even for those two companies.
Sports betting, Supreme Court said it's okay now. So many states are adopting it right now. It could be argued that that's going to dilute some of the interest in Vegas as a gaming mecca. You don't agree with that, though. Why?
You know, Bill, I don't, because really when you think about it, where else in the world can you get the iconic, time-tested, full experience that Vegas offers? I mean, really nowhere. I mean, you have tribal casinos in California trying to challenge Nevada and Reno and Vegas, but really they don't have what Vegas has. There's even arguments, you know, I've heard that the stocks and gaming will still continue to flow through Vegas because that's where all the knowledge is, where all the books are. So, you know, Vegas is still the center of the universe for gaming.
We'll know this fall when football season gets underway.
Exactly.
Dan Peltier with Skift. Thanks for joining us tonight.
Thank you.
It is time to take a look at some of today's upgrades and downgrades. The Dow component Nike was given an overweight rating in new coverage at Morgan Stanley. The analyst says Nike is positioned to increase its share of high-growth global activewear markets. The price target is $88. The stock rose more than 1% to $78.65. Tesla was upgraded to outperform from perform at Oppenheimer following its earnings report that we told you about last night. The analyst cites gross margins for the Model 3 and says that average selling prices remain stable and elevated. The price target is $385. Shares soared 16% to $349.54.
Mining company FreeportMcMoran was upgraded to neutral from underperform at Bank of America Merrill Lynch. The analyst there cited the stock's valuation and a better outlook for copper prices. Price target $17. But despite that upgrade, the stock closed down about 1% at $15.43. Wendys was downgraded to neutral from buy at Kalinowski Equity Research. The analyst cited the channel checks that it's been doing and expectations for same-store sales. Wendys is scheduled to report earnings next week. Stock fell about a fraction today to $16.65.
Still ahead, fees fight, why it's costing less and less to invest.
CBS reported better than expected earnings and revenue for the second quarter today, thanks to growth in its streaming services and higher ad sales. The results, however, were, of course, overshadowed by the recent sexual harassment allegations against CEO Les Moonves, which, it turns out, were not addressed during the conference call. Despite the better than expected results, shares fell in extended hours trading tonight. Julia Borston joins us now from Los Angeles. I mean, the earnings call was pretty much business as usual. Is that what was expected?
Well, the earnings call is very much business as usual. The company's head of investor relations opened up the call by saying that because of pending litigation, there would be no comments on anything but the quarterly results. Because Les Moonves had responded to the allegations that were reported in the New Yorker article with a comment, many people, including myself, thought that he would make some sort of comment on the earnings call. But it was perhaps a surprise to myself and others. It was all business as usual.
And what did he say? How is business for CBS right now?
Well, CBS's earnings per share grew about 8% and the revenue grew about 6%. They're just a hair stronger than expectations. But Moonves really focused most of his comments on the company's digital growth. The fact that they're growing their over-the-top direct-to-consumer streaming services, CBS All Access and Showtime OTT, stronger than expected. A lot of focus on how he's helped grow the company and build the company to be prepared for this digital future. But again, no reference to either of those allegations of sexual misconduct or the pending litigation with Sherry Redstone.
Julia Borston in Los Angeles. Thanks, Julia.
Stronger demand helps Dow DuPont beat expectations, and that's where we begin tonight's market focus. The chemicals producer said higher prices and a rise in sales for seeds and insecticide helped drive its earnings. Not everything in the report was good news, though. Dow DuPont said higher raw materials costs and industry headwinds as a result of trade tensions would cause growth to slow. And the shares fell on that downbeat outlook, and they were off 2% to 66.44. Aetna's decision to exit the Affordable Care Act's health insurance exchanges led to a drop in overall costs. The health insurer, which topped both profit and sales expectations, also said it kept expenses in check. Shares of Aetna were up a fraction to $187.05. Gross margins came under pressure over at Clorox as that company faced higher commodity costs. Clorox did say it does not expect margins to deteriorate further. It is forecasting flat or modestly higher margins for fiscal 2019. That guidance came after the company topped profit expectations but missed on sales. The shares climbed 6% to $142.44.
Kellogg also said that its margins got hit, but for a different reason. The maker of Frosted Flakes said that lower prices and increased spending on marketing and transportation is what hurt its results. But the company topped analyst estimates thanks to stronger demand for its Pringles chips and those popular Eggo waffles. Kellogg also raised its sales guidance for the full year. Shares rose a fraction today to $69.88. Starbucks has struck a partnership with Chinese tech giant Alibaba to expand the coffee chain's digital and physical footprint in China. Starbucks saw performance in that region slow recently, but said that it expects this new collaboration to give the business an extra jolt.
Most of the growth of transactions in China is coming from our new store growth. Now, yes, we did have a negative 2% same-store sales comp last quarter. But, you know, if what I look at what we're doing here with Alibaba and the digital flywheel and enabling delivery, this is like rocket fuel for the digital flywheel in China. And this will be an accelerator for our business, no doubt.
Starbucks shares fell a fraction today to $51.68. Shares of Alibaba were down more than 1% to $182.60. And wireless speaker company Sonos made its market debut on the NASDAQ today. Big one. The company priced its IPO at $15 a share. That was below its earlier target range of $17 to $19. Competition is intense in that business, but Sonos said it actually partners with its competitors, and executives say it's a strategy that is working.
Now, what we're doing is riding the wave of streaming. So this rise of Spotify, Pandora, Apple Music has been fantastic for us. Over the last 6 months, we've added 1 million households in the fastest time yet. Nobody thought we could put all the competitive streaming services on one platform. Right. We have Amazon Alexa on the platform today. We have Google Assistant coming later this year.
Well, shares spiked 32% today to $19.91. Something's working.
Something's working indeed. A growing number of investors are using ETFs as a way to put money into the market, and they're relatively easy to understand and they're cheap. And as Bob Pisani reports, they're getting even less expensive.
7 months into the year, ETF investment flows have been strong, but it's not like 2017. $148 billion has flowed into the U.S. ETF business in the first 7 months of the year. That's a respectable 4% increase. But that's a far cry from last year when roughly $280 billion came in during the first 7 months. Now, the lighter inflows are due to that big hiccup in volatility we had in February. Remember that? So while U.S. equity continues to see inflows of $53 billion, that's a respectable number, investors haven't given up their love affair with fixed income. $50 billion went into U.S. fixed income. A large part of that, though, was high yield. Now, that's not surprising. And think about it. The primary risk in high yield is not interest rate risk, it's credit risk. And with the U.S. economy so strong, credit's holding up very well. But inflows aren't really the hot topic in the ETF business. You know what it is? It's the fees, and they just keep dropping. Many platforms now offer no commission trading under certain conditions. Platforms like Fidelity and Vanguard, for example. But yearly fees have also been dropping. Average ETF fee in the major platform over at iShares has dropped 25% in a few years, and it's even lower at Vanguard. Now even the lower cost index funds are starting to cannibalize each other and lower the cost. So where's this all going? My bet is that before too long we will see a zero fee ETF, zero, which will be a loss leader that will be used to sell people higher value services. This is great news for consumers, but it's making the consumer investing advice business a lot tougher. Shares of many big names like Federated, Franklin, Legg Mason, they're down more than 20% this year. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Todd Rosenbluth joins us now to talk more about Fidelity's move to lower fees and no-fee funds and what it means for you. He is the Director of Exchange-Traded Funds and Mutual Fund Research at CFRA. It's great to have you here, Todd. Welcome back.
Thanks a lot.
So where is this going? We've posed the question in our meetings whether this is kind of a race to the bottom in this particular part of the financial services industry. What do you think?
Yeah, we're there. So Fidelity offering a zero-fee mutual fund, or two of them, that are going to launch tomorrow is a big deal. The asset management industry has not wanted to break the seal, but they now have done so. And now if you're a mutual fund fan, you can get for free. And if you want other products, the fees come down sharply at Fidelity the same way it has at other firms, which is great for investors.
Great for investors because there is the move, and has been for a number of years now, toward passive investing, index investing, as opposed to active management. What happens to active management now?
Well, we think they really need to differentiate themselves. One, we hope to see fees coming down for actively managed mutual funds. You really need to price yourself against a zero or near zero benchmark that's out there, and need to justify why you're different based on the holdings inside the portfolio, what makes your mutual fund unique, not just based on its track record, not just based on its fees, but really what's inside that portfolio.
You know, it seems to me it's also about grabbing market share and how big your footprint is. Fidelity has a big footprint. You know, Vanguard has a big footprint. Is that what this game is ultimately about?
Yeah, so it would be great to continue to gather assets for new products, but what we're really seeing is the goal to retain existing assets on the Fidelity platform, on other brokerage platforms, and be able to provide additional services to customers outside of that zero-fee product. So Fidelity has really been the first to do that. We would expect to see additional pricing coming down across the index mutual fund landscape. There's a lot of products out there that charge way too much money for investors when they can get something for a lot less.
That I get, but I'm skeptical enough to ask, if I'm paying nothing, am I getting my money's worth? And I'm going to be paying for something somewhere along the line. There's no free lunch.
There is no free lunch, but if you only want a low-cost diversified index fund that holds Apple, that holds Amazon, that holds Coca-Cola, as well as some small and mid-cap companies, you can now get that for zero from Fidelity. You can get that for near zero from Vanguard and Schwab in the mutual fund world, and from iShares and State Street and other firms in the ETF world. So you can get that. You just have to decide if that's all you want. If you're in the door, you got to stay in the door sometimes.
Yeah.
There we go.
True.
Well said. Todd, thank you very much. Todd Rosenbluth with CFRA Research.
Coming up, when a heat wave gives you lemons. The Trump administration is proposing a rollback of federal emissions standards. The White House wants to freeze a rule mandating that automakers make cars more fuel efficient. The move sets up a showdown with the state of California, since new federal standards would theoretically supersede that state's own strict emissions rules that have been in place for a long time.
Fiat Chrysler is recalling more than 1 million Ram pickup trucks. The automaker wants to fix a defect that could result in the tailgates flying open while moving. The company says there haven't been any injuries or accidents connected to the defect.
A longtime staple of the American mall has filed for bankruptcy again. Brookstone, famous for its massage chairs and gadgets that we didn't know we needed, plans to close all 100 of its remaining mall stores. This is the company's second bankruptcy filing in 4 years. The plan now is to keep its website up and running, along with some airport outlets, as it looks for a buyer.
And finally tonight, a heat wave in California is causing that state's lemon harvest to finish on a sour note. A decline in supply is driving prices up, squeezing the consumer. Aditi Roy has the story for us from Sonos, California.
The green lemons growing on the trees at Underwood Family Farms right now appear right on schedule for harvest next year. But just a few weeks ago, the trees weren't as giving.
And then the hot spell hit, and that's really impacted our season.
An unforgiving heat wave seared through Ventura County with temperatures as high as 120 degrees. Citrus officials say it knocked down up to 15% of the region's lemon crop at the tail end of the harvest. Craig Underwood's been growing lemons for 50 years and says he lost about half the fruit that was still on trees.
Fruit that was still not picked, if it was yellow, it fell on the ground. If it was small, it also fell on the ground.
As lemons dropped, prices soared. The shortage, which was worsened when Mexico, Chile, and Argentina reported their own supply issues, has driven up wholesale lemon prices more than 60% since the beginning of June. Industry watchers say prices are the highest they've seen in a decade. Now customers are getting squeezed.
This one was 87 cents, which seems like a lot.
Retailers have either been hiking prices or simply removing lemons from store shelves. And that's left some lemon lovers sour.
I noticed there aren't as many in the stores, and they don't seem to be as good a quality.
But looks can be deceiving. This one's a bit small and shriveled on the outside, but on the inside, tastes just fine.
Still, one major distributor sent out a tweet encouraging customers to switch to limes. But that's proven to be a touchy subject.
You know, I'd use a lime.
If you want a lemon, buy a lemon. If you want a lime, buy a lime.
Well, of course, there's a difference, but, you know, we must be adaptable.
For those lemon purists, relief is still several weeks away. Prices are expected to go down in September or October when the region's next harvest will take place. For Nightly Business Report, I'm Aditi Roy, Somis, California.
Well, before we go, let's take a final look at the day on Wall Street. The Dow was down 7 points, even though Apple was its best performer and hit $1 trillion market value today. NASDAQ added 95, technology strong, S&P up 13 points today.
And that'll do it for us tonight. I'm Sue Herrera. Thanks so much for joining us.
I'm Bill Griffith. Have a wonderful evening. We'll see you tomorrow.